Most people are chasing the wrong credit score, and the score you're looking at may not even be the score your lender's using. And when you walk in thinking your 720 is your ticket in, the lender may be looking at a score from a model you haven't even seen. That's not a technicality. That's why people who believe they have good credit can still come out of a loan with a worse rate than they expected or get denied altogether. So today I'm going to show you what actually matters before a lender pulls your credit. Not credit tricks, not the perfect 850 obsession, what actually matters. Because perfect credit sounds good, but loan-ready credit is what matters. I spent over 20 years in the lending industry. I've reviewed and analyzed thousands of credit reports, and I've had direct conversations with the credit bureaus. I'm not passing along something that I read. I'm telling you what I saw in real files and with real people. First, you don't have one credit score. You may see one score in Credit Karma, another score from your credit card company, another score when you apply for a mortgage, another score when you apply for a car loan, another score when you apply for a credit card. So why are the scores different? Because they may not be using the same scoring model. Credit Karma usually uses Vantage Score. Vantage Score was created by Equifax, Experian, and TransUnion. FICO is different. But here's where people get confused. FICO still uses information from those three bureaus. So you can have an Equifax FICO score, an Experian FICO score, and a TransUnion FICO score. Well, how can these FICO scores be different? Because the information at each bureau may be different. And why would the information be different? Because not every creditor reports to all three bureaus. Some creditors report to Equifax, Experian, and TransUnion. Some report only one or two. So one bureau may know about an account, balance, inquiry, or late pay that another bureau doesn't show. That's why your scores may not match. So when someone says my credit score is 740, the real question is, which score? Your middle score? From which bureau? Using which model? For what type of loan? That's why people get frustrated. They check one app, think they're fine, apply for a loan, and then the lender shows them a completely different number. Does that mean Credit Karma is fake? Nope. Does that mean FICO is fake? Not at all. They're just analyzing your credit in different ways. One model may put more weight on certain parts of your credit profile than another model does. Now, FICO matters because it's still the score family used by about 90% of the top lenders in the US. But don't obsess over the score difference. Start with the information creating the score. Are the accounts correct? Are the balances correct? Are the late payments, if there are any, are they accurate? Are the accounts yours? Are there collections you don't recognize? Don't start with the score, start with the information creating the score. That's why you need to review all three reports before a major loan. Not just one app, not just one score, all three reports. Because the lender is looking at what is actually being reported. Payment history is the foundation, and under FICO, it makes up about 35% of your score. That's the largest single factor. So if you have recent late payments, charge-offs, collections, repossessions, or serious derogatory accounts, that's going to matter. But people also misunderstand late payments. There's late, and then there's 30-day late, and those aren't the same thing. If your payment is due on the 5th and you pay it on the 8th, you were late with the lender. But that doesn't usually mean it reports as a 30-day late on your credit report. For credit reporting, the real damage usually starts when the account reaches 30 days late, then 60, then 90. And the deeper it goes, let me tell you, buddy, the worse it gets. A credit report is a snapshot of how your credit risk looks right now. That's why a 30-day late from last month usually matters more than one isolated 30-day late from, say, 2 years ago. Recency matters. Severity matters. Pattern definitely matters. A 30-day late is different from a 90-day late. One late payment is different from repeated late payments. And recent problems usually matter more than older problems. So what's the point? Lender late and credit report late are not the same thing, but you still want to pay on time every month. Set up auto pay for at least the minimum. That guarantees you won't miss a payment if life gets in the way. But remember, during the month, you can make other payments to your account. Pay that balance off each month. Auto pay is just that security blanket. A credit card should not create spending power you don't already have. It should be a payment tool, not a way to stretch your paycheck. Credit cards work best when they follow your cash flow, not when they replace it. The next major factor is amounts owed, or utilization, and under FICO that makes up about 30% of your score. A big part of that is how much revolving credit you're using. If you have a $10,000 credit limit and a $5,000 balance, you're using 50%. If you have a $10,000 limit and a $1,000 balance, you're using 10%. Lower is usually better. But here's what people miss. Why can your score drop even if you pay the credit card off by the due date? Because your score may not be based on what you owe on the due date. It's based on what reports, and what reports may not be your balance on the due date. Many times, the balance reports around the statement closing date, but don't guess. If you're applying for a mortgage, auto loan, personal loan, or any major credit, call the creditor and ask, what date do you report to the credit bureaus? Do you report to all on the same day? Usually so, but you never know. Then make sure the balance is low or zero around that time. That's different from just paying by the due date. Paying by the due date keeps you from paying late. Paying before the reporting date helps manage what the credit bureaus see, and those aren't the same thing. Now, here's what some people don't know, and it directly affects what we were just talking about with the reporting dates. If every one of your credit cards reports a zero balance, the FICO model will actually penalize you. Not reward you, but penalize you. The model interprets all zero balances as no revolving activity, and that triggers a scoring deduction somewhere around 15 to 20 points depending on the model. This includes FICO 8, FICO 9, and the older mortgage-specific models FICO 2, 4, and 5. If you're applying for a home loan, these older models are often what the lender's using, and they're the most sensitive to this. So before you apply for a loan, ask the creditor or the lender what scoring model that they're going to be using. So what's the right move? Let one card report a small balance. $10 to $50 is enough. Pay every other card to zero before the statement closing date. Keep your overall utilization under 10%. That one card with a small balance tells the model you're actively using credit and managing it responsibly. And I've seen this over and over again. People do everything right, pay everything off, and still wonder why the score didn't move the way they expected. And sometimes this is. You're not carrying debt, you're not paying interest, you're managing one small balance strategically so the model scores you the way you deserve to be scored. Don't confuse activity with debt. You can still use the card, pay it off by the statement due date, avoid interest, and still build a strong credit history. If your utilization is high, find out why. Is it a timing problem? You pay in full every month, but the balance reports before you pay it. Is it a debt problem? You're carrying balances and need a payoff plan. Is it a cash flow problem? You're using the card because your income and expenses don't line up. Those are different problems. If it's timing, control what reports. If it's debt, build a payoff plan. If it's a cash flow, fix the budget first. A credit score trick won't fix a cash flow problem. Now, a debt consolidation can help in the right situation. If you use a personal loan to pay off several credit cards, those cards may report zero balances, and that can make the credit report look cleaner. It can also improve revolving utilization. But did the debt disappear? No, it just moved. You took debt from several credit cards and reallocated it into one new installment loan. So the question isn't, did my score go up? The real questions are, did it improve my cash flow? Did it lower my interest costs? Did it create a payment I can actually manage? And am I going to use this improved cash flow to pay the debt down? Because if you consolidated the cards and then charged the cards back up, now you got the consolidated loan and new credit card balances. Not to mention, I can guarantee you, you probably have the bankruptcy attorney on speed dial there in the future. Debt consolidation can clean up the way the debt looks, but it doesn't clean up the debt itself. You still have to pay that down. And debt consolidation is not debt settlement. Debt consolidation means you're still paying what you owe, just in a different structure. Debt settlement usually means you stop paying, let the accounts go delinquent, and then try to settle for less. And that can damage your credit. So don't confuse the two. Closing credit cards is another area where people get bad advice. Some people think they can close newer credit cards and not hurt their score because the card is new. But is that the whole story? Well, no, not really. Closing a newer account may not hurt the age of credit the same way closing your oldest card could. But if that card had a credit limit and you close it, you may lose some available credit. And if you have balances on other cards, your utilization can jump immediately. So closing a card isn't automatically bad, but don't close accounts blindly. Look at your total limits. Look at your balances. Look at the annual fees. Look at whether you're applying for a loan soon, and look at whether your credit file is thin or well established. The wrong account closed at the wrong time can hurt you. Credit limit increases can also affect utilization. A credit line increase can lower utilization because the same balance is being measured against a larger limit. But before you request one, ask how the creditor handles that request. Will it be a hard inquiry or a soft inquiry? A hard pull usually happens when you apply for credit, and it can affect your score. A soft pull is more of a review or check of your credit, and it doesn't affect your score. And don't treat a higher limit like it's new income, because it's not new income. It's just more available credit. And if you use it, you're right back in the same problem. Now, you can also ask a creditor to lower the credit limit. Some people do that to protect themselves from overspending because they don't trust themselves, or they don't trust their spouse. But understand the trade-off. A lower limit can make your utilization look worse if you carry a balance. Length of credit history makes up about 15% of your FICO scores. This includes how long your accounts have been open and the age of your overall credit history. That's another reason you don't want to close accounts blindly. Time matters in credit. You can't fake it, and you can't rush it overnight. A paid-off car loan can still help your history, but it's no longer an active installment account. Over time, that account becomes older history instead of current proof that you're managing that type of debt today. That's why someone can pay off a loan and still see the score move in a way they didn't expect. The loan was paid as agreed, and that's good, but the active account changed into a closed account. Authorized user accounts can help some people. If the account is old, clean, and low utilization, it may help your file. But is it the same as having your own credit history? No, and it carries risk. If the primary cardholder pays late or runs up the balance, that can hurt you. Some lenders may also look differently at a file built mostly on authorized user accounts. So use this carefully. It's not a shortcut to avoid building your own credit. New credit makes up about 10% of your FICO score. That includes recent inquiries and newly opened accounts. And this is one of the most misunderstood parts of credit. Some people panic over every inquiry. Now, does one hard inquiry usually destroy your score? No. But can inquiries and new accounts create problems at the wrong time? Yes. If you're getting ready to apply for a mortgage, that's not the time to open random credit cards, finance furniture, apply for store cards, or let people just randomly pull your credit for no reason. Years ago, I had a couple that was buying a house and there was a delay in the process. Their credit report expired because credit reports have a certain date before they're no longer good. And we had to pull a new one. During that delay, they had financed furniture for their new house. That new furniture loan dropped their score and it was below the minimum. And it pushed their debt to income ratio a little too high. And we ended up having to deny that mortgage. So now they had all this furniture and no house to put it into. That's why I always tell clients, don't take out any new loans until the main loan that you're focused on is not just done, but funded. There's a big difference between done and funded. Rate shopping is different. If you're shopping for a mortgage or an auto loan, multiple inquiries within a short window may be treated just as one inquiry. You're expected to shop for the best deal. So don't fall for that sales pitch of, your score is going to drop if John Doe down the street pulls your score. No, it's not going to happen. But do it in a reasonable amount of time. Some models are going to give you 14 days up to 45 days that you can make multiple inquiries. But keep in mind, that's not the same as applying for 5 credit cards. A mortgage inquiry, an auto inquiry, and several credit card inquiries are not treated as like one event. Rate shop with a purpose. Keep it inside a tight window and avoid unrelated credit applications before a major loan. Credit mix is the last 10% of your FICO score. This looks at whether you have different types of credit, like revolving credit and installment loans. But should you borrow money just to improve credit mix? Nah. Don't get an auto loan, personal loan, or a mortgage just to impress a scoring model. That makes no sense. The scoring model doesn't like to see credit with finance loans and subprime loans. And I get it, because the question can become, well, why did you go to a subprime place to get a loan? But here's the flip side of that. Years ago, when my wife and I were just starting out, we went to go get some furniture. And the store was offering 12 months, 0% interest. And at the time, that made sense for us. We signed the papers, paid it off within 12 months, and paid 0 interest. From a financial standpoint, it worked. A few months later, I went into Nations Bank, which is now Bank of America, and applied for a loan. The loan officer asked me about that finance company account, and I explained it was 12 months, 0 interest furniture deal. She told me we should have come to the bank instead of the finance company account because it didn't look good on the credit report. So I asked her, would you have given us 0% interest? And she said no. I said, well, there you have it. Financially, I still think we made the right decision, but credit-wise, it was a double-edged sword. The loan saved us interest, but the type of lender showed on the credit report made it look different. I don't think that's always fair, but I don't make the rules. So when you borrow, don't just ask, can I get approved? Ask, who's the lender? Who will this report to? What's the interest rate? What are the fees? And does this actually improve my financial position? Because sometimes a deal can make sense financially and still have a credit file trade-off. If you have no credit, you may be able to start with a small secured loan through a credit card or a small secured loan through a local bank or credit union. The point is not to borrow more than what you need. The point is to create a small, manageable account you can pay as agreed. A credit freeze is one protection step that people overlook. It's free. It doesn't hurt your score, and after breaches like national public data, where Social Security numbers and personal information were exposed, freezing your credit isn't extreme. It's basic protection. You can freeze your reports with Equifax, Experian, and TransUnion. Then when you need to apply for credit, you just go and freeze them. You can go to their websites. You can do all 3 easily in less than 20 minutes total. This isn't about improving your score. It's about protecting your credit file. If something is in your credit report is wrong, dispute it. If an account isn't yours, dispute it. If a late payment is inaccurate, dispute it. If a balance is wrong, dispute it. If a collection is reporting inaccurately, dispute it. But should you dispute accurate information just to see what happens? No. If you dispute it, use documentation. Keep records. Put it in writing what's needed. The goal isn't to play games with the credit bureaus. The goal is to make sure the reporting is accurate. If you had one isolated late payment and the account is now current, you could try a goodwill letter. But is a goodwill deletion guaranteed? No. It's a request. It's not a right. The creditor doesn't have to remove accurate reporting. Now, it may work in some situations, but don't build your whole credit plan around hoping someone deletes accurate information. Repossession is another area where people misunderstand. Some people think a voluntary repo doesn't hurt because they gave the car back. Does giving the car back save your credit? Nah. Voluntary repossession sounds softer, but it's still a repossession, same as involuntary repossession. The difference is whether you bring the car to them or they come and get it. Either way, the loan wasn't paid as agreed. Now, you may reduce some recovery costs by returning the car yourself, but you don't save the credit report. And if the lender sells the car for less than what you owed, you may still owe the deficiency balance. So don't think handing over the keys makes the credit damage disappear, because it doesn't. And that brings us to the one myth that trips up most people more than anything else. Do you need an 850 credit score? No. A perfect score feels good, but lenders aren't handing out trophies. They're pricing risk. At some point, extra points may not save you any more money. For many loans, once you're in the strongest pricing tier, the extra points may look nice, but they may not change your rate. Now, that doesn't mean your credit score doesn't matter, because it certainly does. But the goal is not perfection. The goal is qualification, strong pricing, and a credit profile that supports the life you're trying to build. So here's the bottom line. Don't chase every score you see in an app. Don't panic because Credit Karma and your lender show different numbers. Don't carry debt just to build credit. Don't close accounts blindly, and don't open accounts that you don't need. Don't confuse debt consolidation with debt elimination. Don't think a voluntary repo saves your credit, and don't think an 850 is the finish line. Pay on time. Keep utilization low. Know when your creditors report. Review all 3 credit reports. Fix inaccurate information. Protect your file. Use credit as a tool. And make sure your credit decisions improve your cash flow, not hide problems in your cash flow. Because the strongest credit profile isn't the one built on tricks. It's the one that shows a lender you know how to borrow, pay, and manage your money without letting debt control you. That's what actually matters. If you're building towards a major loan and you want to know how to do it the right way, not the quick fix way, subscribe. That's what this channel is here for. And I'll see you in the next video.